Okay, probably we will start now. Very good morning, everybody. I'm Jennifer. For those of you who don't know me, the Executive Director of the BMCC. Welcome. Welcome to the BMCC webinar series on the impact of COVID-19 to businesses. This morning, we have a distinguished speaker from the World Bank, Richard Record, who will be sharing with us the economic outlook analysis for Malaysia and the region. Let me just briefly share about our speaker here. Richard is the lead economist for the World Bank in Malaysia. I'm sure many of you know Richard. Richard is no stranger to the BMCC and to many of us as we have had him before as our guest and guest speaker. He is in the World Bank's group Macroeconomics Trade and Investment Global Practice based in Kuala Lumpur. Richard is involved in the bank's engagement on economic policy issues in Malaysia, including the flagship Malaysia Economic Monitor and the report on Malaysia's digital economy. We look forward, Richard, hearing from you on the economic outlook in 2020 amidst these uncertain times that we all are facing, unprecedented times. So hope, that you can shed some light to us. There is light at the end of the tunnel. If it's not in the short term, it's not in the short term, at least in the medium term. So before I pass it to, we look forward to interesting insights from yourself. But before I pass to Richard, let me just let the participants know that if you have any Q&A, please do ask the questions to the Q&A tab and not the chat tab. And we will be monitoring the questions. And at the end of Richard's session, we will answer the Q&A sessions. So with that, let me pass over to Richard. Over to you, Richard.
Great. Thank you very much, Jen. And good morning to everyone. And thank you for that introduction. So I'm going to share a little bit of our economic analysis and assessment for Malaysia and the region this morning. I have a slideshow put together, although I'm going to ask one of our colleagues from the BMCC Secretariat to present the slides, although I think we can circulate them afterwards as well. But basically, I'm going to take you through some of the work we've done. We released a report okay, I can see the slideshow there, although the text looks a bit funny. But anyway, let's proceed. Hopefully the rest of the slides are okay. So presenting work from our recent regional economic update that we released a couple of weeks ago, and I send the web link at the end of the slideshow with some of that in more detail, as well as some of our analysis on Malaysia's economy, including on the fiscal stimulus and the various other packages that have been released over the last few weeks, and what kind of impact we think they'll have, and what kind of options Malaysia has, essentially, if the government needs to do more to stimulate the economy. But essentially, there are sort of four main messages. I think the supply shock that, well, if you roll back to earlier in the year in January, we were thinking of this COVID-19 essentially as a supply shock that was affecting tradable economies through global value chains. But of course, now that shock has morphed into a global economic shock. And of course, Malaysia now faces the prospect of an economic contraction within Malaysia, as well as a global recession. We've seen a number of measures that the government has taken here to contain the impact of the virus. But I think the challenge is we really don't know quite how long and how prolonged this shock is going to be. Malaysia has sort of undertaken a significant economic stimulus, but it has limited space, and there's perhaps a concern that almost everything that could be deployed has now been deployed, and so the government needs to do more to mitigate the further impact of the shock. Then it will perhaps need to dig deeper and consider some more unorthodox measures. And of course, this is all taking place perhaps unhelpfully during a period of political change and uncertainty. So go to the next slide. I think I'll start off firstly by looking at the impact of the pandemic on the regional economy that we've seen over the last month. So if we can go forward a couple of slides, please. So we've seen a pandemic which has triggered now what is almost certain to be a global recession. I think by now you'll all be quite familiar with these kind of charts showing the incidence of COVID-19 cases. Perhaps, what is perhaps fortunate, I think, from Malaysia's case is that the pace of acceleration has been substantially slower here, and it continues to decelerate, especially so during the last week. So it appears that Malaysia has been on a trajectory which looks a lot less worse than we saw in China, and a lot worse than we've seen in Europe and in North America, including in the UK. However, that sort of the economic impact, is expected to be equally significant. On to the next slide. What we've seen, of course, is severe turbulence and uncertainty in financial markets. We've seen significant volatility in both commodity and financial markets, and we've seen large outflows, including from Malaysia. You can go to the next slide, please. Significant volatility in financial markets, and on the slide after that, we've also seen significant volatility in commodity markets. I think what's quite interesting is that we've seen the most severe plunges have been in energy markets. That left-hand chart shows just 3 different indices of energy, agricultural, and metal prices. What's interesting, if you look on the right-hand side, is the commodity which has seen the biggest decline is crude oil. That's the differences between March and February, or a 40% decline. And if you look at that, among the handful of commodities that have seen price increases, the one that has seen the biggest increase has been rice, which has seen just over a 10% increase. What's perhaps interesting is, of course, Malaysia is a net exporter of oil and a net importer of food, including rice. So what that essentially means is that Malaysia has experienced quite a severe, what we call terms of trade shock, among economists, meaning a relative deterioration on exported products and a deterioration on the prices of imported products, and that doesn't really help from a trade perspective. On the next slide, if you look at the impact of the crisis, we saw initially those countries that were most affected were those who were integrated through either manufacturing, through imports and exports, and tourism, essentially services trade, most intensely with China. And sorry, if we go to the next slide, please. Essentially, Malaysia sort of is about middle of the road, if you like. It's not the most integrated with China, but it's sort of somewhere around the middle point and compared to other economies in the region. So essentially, Malaysia was impacted quickly as China slowed down, and perhaps on the upside, if we start to see some signs of a recovery in China before other economies, then hopefully that will sort of result in a positive impact or feedback loop on China. Sorry, on Malaysia relative to China. And the first quarter numbers were just released this week and showed, as expected, a very severe decline in China's economic activity, but the high frequency numbers, certainly what we've seen through April, suggest that we will likely see a fairly rapid recovery as well. Of course, many countries, in fact, most countries around the world have now imposed severe movement restrictions, and this chart just gives you a sense of that, including of Malaysia. That matters, of course, for economies like Malaysia that trade intensively in services, including tourism. Moving on to the next slide, of course, we've seen the impact of the MCO here. If we compare that in terms of the impact on movement, particularly in terms of local and urban transportation, F&B, retail, recreation activities, you can see that perhaps Malaysia and the Philippines are the 2 economies that have seen the most, perhaps, dramatic decline in movements relative to other economies. I think the hope, of course, has been that would flatten the curve faster than other economies and perhaps allow for a gradual resumption. But I think this gives us a pretty good early warning indicator of what we can expect sort of the high frequency economic activity numbers to look like in March and April as they are released. So what is all this happening on world economy? On the next slide, you can see some of our World Bank projections on what we think the changes to the baseline for growth and exports will be for economies around the world in what we call a baseline scenario and an amplified scenario. So on the next slide, you'll see on the left-hand side, essentially, is what do we expect the negative impact of the shock of COVID-19 to be on exports and GDP under what we call a baseline scenario, which essentially is where the COVID-19 would persist through much of 2020, but we would see the beginnings of a recovery in the fourth quarter. And in the amplified scenario, we would see distortions throughout this year and the recovery coming, deeper distortions, and the recovery coming only in the beginnings of 2021. And both on advanced economies as well as on economies in this region, that's obviously quite a severe impact. Malaysia is no exception. And essentially, we would see GDP in the baseline scenario losing close to, well, 3 to 4% from its potential trend rate, and in a amplified scenario, leaving more like 4 to 5%. And I have a slide further on where we have our specific projections on different scenarios for Malaysia. On the next slide, you can go forward. You will see perhaps the dual challenge as we see it that the government faces here between flattening the curve on the pandemic, and I think most of us will be familiar with that chart on the left-hand side. The challenge, of course, is to contain the pace of infection so that it falls below the health system capacity. But of course, equally, governments need to mitigate or contain the impact of the pandemic on the economy. Essentially, in the worst case scenario, the impact of flattening the pandemic curve results in a very deep recession without compensatory macroeconomic measures to try and deepen the impact on the recession. And so essentially the question is, well, what has Malaysia done, and is it enough to try and relatively mitigate that potential recession that we're likely to see? So on the next slide, in our regional report, we've had sort of 5 main messages that we think apply both to economies of the region as well as in Malaysia. Firstly, of course, the short-term challenge is about boosting healthcare capacity to ensure that systems are not overwhelmed in the short term. Certainly, the evidence seems to be that Malaysia's systems are not being overwhelmed right now, but I think that's not necessarily the case in some of the other economies in the region, particularly those that are relatively less developed. Secondly, there's a need to adjust fiscal and monetary policies to meet the COVID-19 crisis. We've seen dramatic movements across the region to both loosen monetary policy by reducing interest rates, reducing liquidity requirements, introducing regulatory forbearance, as well as the implementation of a number of fiscal policies across the region. It's important to ease access to credit for households and for firms. Fourthly, trade policy needs to stay open, and we're encouraged by the messages just last week at the ASEAN summit. The reality is there is enough medical and PPE equipment around the world and enough food around the world to meet all demands, but if there are trade frictions, then problems can result. Just to give you an example, Malaysia produces 65% of the world demand for sterile nitrile medical gloves, but of course has very large import requirements in other areas. So trade needs to flow. And finally, we've been emphasizing the importance of international cooperation to develop not just to ensure an adequate supply and production of medical products, but also efforts towards vaccines and tests that we think will be necessary to move towards a new normal. So second half of the presentation, I'm going to go into Malaysia's particular economic outlook. So if we can move forward the slides 2, please. So again, in Malaysia's case, we've seen very severe turbulence in financial and economic markets. We've seen the KLCI decline substantially, although perhaps not necessarily so differently to other indices in the region, consistent with outflows from emerging market and developing economies. We've also seen the ringgit under severe pressure, declining by almost 7% over the last couple of months. Again, although I think quite consistent with other emerging market and developing economies, reflecting outflows and relative risk premia in emerging economies. On the next slide, certainly the early indicators suggest that we are already seeing a very sharp drop in economic activity. We're seeing very dramatic reductions in consumption patterns, almost 95% reduction in consumption of clothing, and something similar for transportation. Of course, that's to be expected given the impact of the MCO. Of course, interestingly, we have seen an increase in food and beverage away from home purchases, but of course, that's by no means does that sort of counteract some of the other declines we've seen across other items in the consumption basket. Certainly very strong evidence that we're seeing job losses as a result of the MCO. especially in agriculture and services, somewhat less in industry, perhaps suggesting that some of the measures to retain the workforce in readiness for a restart of production are a little bit more effective in the industrial sector. And early indicators suggesting that both exports and imports will be dropping sharply already in February and very much so into March and April until we move to an NCO phase that has more limited restrictions on industrial activity. On the next slide, we can present our economic projections for Malaysia. And these are ones that we released a couple of weeks ago. And within these, essentially, we presented two scenarios, if you like. A baseline scenario, as I indicated, which would see restrictions through much of the second and third quarter, although gradually becoming less restrictive, particularly towards the end of the second quarter and in the third quarter, and a recovery in the fourth quarter, and therefore a sort of return to full growth in 2021. That's probably sort of something of a U-shaped recovery, U-shaped impact. And then we also presented an amplified pandemic scenario where we would see a deeper impact on global economic activity and a deeper impact on Malaysia's economic activity within 2020, and the recovery only coming into 2021. So on the baseline scenario, Malaysia's GDP growth is negative 0.1% this year, returning to a full trend rate of 6.4% in 2021. And then in the sort of lowercase amplified pandemic scenario, GDP would contract by 4.6% in 2020 and return to only 4.1% in 2021. Moving on to the next slide, we see sort of three main risks and challenges to the outlook. Firstly, as I mentioned, a more prolonged outbreak would result in a deeper contraction and a delayed recovery. Secondly, we're concerned about the limited fiscal space. Essentially, government has deployed pretty much all of the resources it has right now to respond to the crisis, and any further or amplification of the crisis would require unorthodox measures, and I'll have a couple of slides on those in a moment. And of course, political uncertainty, which has an impact on the extent to which investment will recover after the crisis. So moving on, a couple more slides I have a few more finally on the fiscal impact of the policy response, which I wanted to share. So going forward a couple of slides, government has now implemented several rounds of fiscal stimulus. Collectively, these now come to about 260 billion ringgit, and that's about just over 17% of GDP. If you compare it with other countries around the world, that actually puts Malaysia among one of the largest stimulus packages globally in an aggregate envelope. I think only a few European economies, including Germany, have responded on a larger scale. However, the sort of fiscal element of that stimulus or response package is actually quite modest at just 35 billion, and that includes the additional 10 billion that came through last week to double the size of the wage subsidy. And that's about 2.3% of GDP, which is certainly not insignificant, but it's relatively more modest when you compare that with other economies around the world. So Malaysia is sort of leaning much more so on financial measures and of course withdrawals from EPF, pension funds, essentially, rather than a direct injection from the Ministry of Finance. And that really reflects the relatively limited space that Malaysia had going into this crisis. It was already running a sizable fiscal deficit with elevated levels of debt and a series of fiscal rules that restrict further borrowing. On the next slide, I won't go into too much detail, but of course we have seen state governments also implement various packages. These are pretty small in aggregate sense, reflecting the relatively limited fiscal firepower that state governments have in Malaysia. Of course, Malaysia is extremely centralized when it comes to fiscal affairs, and so there's sort of limited scope to deploy measures at the local level. On the next slide, our sort of three main observations is that, of course, as I mentioned, the fiscal element of the stimulus is relatively modest. The level of wage subsidy, of course, I think it's novel. It's something that's never been tried before in Malaysia. And there are a limited number of developing countries that have gone so far as to implement wage subsidies as part of their response packages. But of course, initially it was 50% of the minimum wage. It's now 100% of the minimum wage. But of course, that's a lot less generous compared to, for example, what we're seeing in the UK, where I think wages are being sorted up to £2,500 a month, and it's fairly modest compared to what we're seeing in Singapore as well. There are also some questions about the speed and implementation of the package. Some elements, of course, can be deployed very quickly using existing mechanisms such as the BSH. Other aspects will take a little bit more time, including the BPN, which has to be set up essentially. And some questions as well around the transaction costs with accessing the wage subsidy as well. Next slide. So what does this all mean for government's fiscal performance? Well, of course, the challenge, or the unique challenge that Malaysia has in 2020 is that it's executing a relatively large round of additional expenditure programs, just mentioned, around 2.3% of GDP, but coming at a time when revenue is under severe pressure. By our estimations, Malaysia will lose a substantial share of petroleum revenues. It's not one for one, but Malaysia's 2020 budget was premised on an estimate of oil at $62 a barrel. It's currently trending below $30. I mean, we think it'll probably hold at around $30 on average through 2020, could be even lower. But that has a major impact on petroleum income taxes and royalties, although less so on the dividends which go into that petroleum revenue stream of the government. With slower growth, in fact, even with a recession, we would expect corporate income tax to underperform. And of course, there are a number of deferrals and exemptions that have been provided as part of the response package. Similarly, with lower earnings, personal income tax collections will underperform. Lower consumption would see weaker SST as well. And so potentially this opens up a sort of revenue gap of as much as 30 billion ringgit, which was sort of unanticipated. So next slide. What does that mean for the deficit? Well, it really depends on how does government try to fill that deficit. But our estimate is that if you add together all of the new expenditure programs that have been announced collectively to support the fiscal response, and you adjust projections about Malaysia's revenue, given what we know about oil prices and the pace of GDP growth, then the fiscal deficit could widen to as much as 7% of GDP, which would be pretty unprecedented for Malaysia, and possibly even larger than we saw after the Asian financial crisis. That would also see Malaysia's debt breaching the 55% of GDP debt limit policy that the government holds. So the question is, well, will the deficit go that large, or will the government try to find ways to fill it, or will they look at ways to change some of those fiscal rules? So on the next slide, Malaysia essentially has four main rules that limit spending and borrowing by the government. Firstly, there's legislation that goes back to 1959 that prevents the government from financing operational expenditures with borrowing. Secondly, there's a debt limit policy that limits total level of debt to 55% of GDP. There's also a requirement that debt service does not account for more than 15% of revenue. And there are specific ringgit limits on treasury bills as well as offshore foreign borrowing. Now, looking at those, essentially the ones that are most binding is the first one, which is the requirement that operating expenditures be financed by revenue. If you go back to previous crises in Malaysia, such as the global financial crisis or the Asian financial crisis, Malaysia's response was to spend heavily, but to spend heavily on development, essentially funding infrastructure and investment activities to support a recovery. Whereas the challenge with this crisis is it's not, at least right now, a lack of demand, it's essentially a self-imposed supply restriction. So, there's no ability to stimulate the economy through development spending when the economy is being locked down under an MCO, whereas the reality is government needs to spend more on transfers and operational expenditures, which of course cannot be financed at the moment through borrowing. So what can the government do? Well, on the next slide, we think they probably have three options. Firstly is to recalibrate existing spending patterns to try and find money within the existing budget, which could be reallocated. There's a quick slide, on the next slide, a quick summary of potential areas where that could be. Firstly, there could be shifts in supplies and services, so shifting expenditure out of current areas into high priority ones. That's some scope for that, but perhaps we're only talking about a few billion, and of course, we would not expect to see, well, For example, we need to free up space essentially for supplies and services in health and security. There are limits to how much perhaps I think Malaysia would want to cut areas such as education. Secondly, there's perhaps some scope to make changes to grants to statutory bodies and make some changes to subsidies. But other areas, for example, you see the largest item on the operating budget is salaries and pension contributions for the civil service. It's very hard to change that in the short term. And of course, debt service is also a very large expenditure item that can't be changed. What else could be done? Well, perhaps most realistically, government might need to look at non-tax revenue. The largest contribution there has traditionally been the dividend from Petronas, but also dividends from Khazanah and Bank Negara are not insignificant. In the same way that Petronas came to the rescue and supported expenditures when the previous government was looking to fill the gap for GST refunds, perhaps that's one option that government might need to look at this time. Non-tax revenue would then perhaps help bring down the fiscal deficit to a level which is a little bit more manageable and address the concerns about needing to borrow to support current expenditures. However, of course, the more that government draws down from Petronas, then Petronas in turn is perhaps weakened in its ability to undertake future investment activities, of course, coming at a time when it will already be under pressure given a weaker oil price. And finally, well, the sort of nuclear option, if you like, is to consider legislative change that would lift some of the statutory limits around public debt management. Indonesia is going through this process right now. It's perhaps not inconceivable that Malaysia could consider a similar set of packages. Sorry, this is the next slide. Malaysia could consider a similar set of perhaps temporary waivers or changes to the legislation to allow debt to go above 55% of GDP, or to consider allowing the funding of operational expenditures with borrowing resources. But certainly in the current political climate, I think that would be quite tricky, given that Parliament, of course, hasn't met yet since the new government was formed. So finally, just a couple of slides beyond the crisis, if we could go forward. Of course, despite a number of challenges, including a global recession, weaker commodity prices, and weaker trade, as well as domestic economic activity, Malaysia does have a number of advantages that make it relatively more resilient compared to other economies around the region. We've grouped those into sort of three main buckets, if you like: economic, financial, and public sector. Sorry, if we could go forward a slide, please. On the economic side, of course, Malaysia does have a very diversified economy, and that certainly helps at a time like this. It's useful to have economic activity across manufacturing and non-manufacturing, E&E and non-E&E, commodities and non-commodities, service sectors, and within commodities, both hydrocarbons as well as agricultural commodities. The relatively high level of digital adoption means that a relatively higher share of Malaysians are able to work during an MCO period or during a period of sustained social distancing. That helps. And Malaysia has quite a good track record in macroeconomic management and crisis response, as well as its resilience of financial institutions. And the early response suggests that the stimulus package is helping to some extent, and some evidence that we're seeing already this week that perhaps the pandemic curve has been flattened so far in Malaysia. But of course, I think we always, in the World Bank, like to sort of encourage governments to use a crisis to undertake reforms, or not waste a crisis, rather to undertake reforms to ensure a stronger recovery. We think it's important to not lose sight of some of those medium-term challenges that Malaysia continues to face. This could be a chance to sort of recalibrate some of Malaysia's investment strategies and investment policies towards a more sort of tighter quality focus beyond the crisis, rather than just chasing the total dollar value of investment we've seen in the past. Clearly, SMEs will find it harder to recover faster, and perhaps beyond the current crisis, it will be important to then think of policies that could allow for reskilling, upskilling of the SME workforce, and perhaps find ways to stimulate demand to support a recovery among smaller firms. I think this crisis has also emphasized the importance of digital development and digital adoption, and more could be done to perhaps close some of the lagging gaps in terms of accessing the digital economy. And then thinking about what a sort of future social protection framework might look like beyond the current sort of scale up of cash transfers. So if you can turn to the final slide, I think I'll stop the presentation there. I think the slides can be circulated afterwards, so that if you have anything you want to refer back to, please do so. On the final page as well, I've uploaded some of the links, including our global COVID-19 resource page, as well as our new report, East Asia Pacific in the time of COVID-19, as well as some other resources on our country page. Thank you very much.
Thank you, Richard, for the insightful presentation and some, interesting, results that you've got in your survey. Before we move on to the Q&A, I actually have one question. Maybe I'll just take the opportunity. You have recommended that Malaysia should consider or should be considering a change in its legislation in terms of allowing debt to be more than 55% of the GDP. What will be Malaysia already has a high fiscal debt. If this happens, what will be the consequences for a country like Malaysia?
Sure. So in Malaysia, one of the challenges going into this crisis is that although Malaysia had been consolidating its fiscal position since the last crisis, the GFC 10 years ago, it was still running a fairly large fiscal deficit, over 3%. And that had led to an accumulated increase in debt to around, Malaysia is pretty much close to the debt limit already, depending on which contingent liabilities and guarantees you include as being in part of debt or not part of debt. So Malaysia didn't have as much space as would have been desirable, and that's kind of been exposed in this particular crisis, and that's why the government has had to rely much more heavily on Bank Negara and EPF rather than MOF to respond to the crisis. Of course, Malaysia is still an A- rated sovereign, although we've seen, I think already Fitch has started to perhaps put Malaysia on a negative outlook in terms of the credit rating. But I think the question is, what is better served? Is Malaysia better off responding aggressively to the crisis and dealing with it and preventing households and firms suffering severe, long-lasting damage to be able to recover faster by deploying fiscal resources now? Or is it better to sort of preserve the credit rating and the debt and the fiscal deficit right now, but then perhaps risk having a prolonged economic outlook with weaker growth? I think we would sort of encourage the government to perhaps invest more now to allow for a stronger recovery. And then, of course, over the medium term, we'll need to look back again at expenditure and revenue sources to put the fiscal framework back on a steady pathway. But this is a crisis that's not affecting Malaysia more so than other economies around the world, and we're seeing sovereigns everywhere, both advanced economies, of course the UK as well, running substantial fiscal stimulus measures, fiscal deficits to respond to the crisis. And so we think that's probably the best course as well for Malaysia.
Okay. I know you just have. I think I can hear what's your answer going to be, but I think this will be an interesting. Everyone is asking. The World Bank is asking the country to focus on non-tax revenues, but there is a question here saying that should they? I'm sure this will put a burden to the people, but should the government be re-looking at introducing GST at a different rate, because that will bring them money in terms of recovery later? What's your view on that?
Yeah, so I guess the question is in the short term or the medium term, so this year and next year. The challenge is right now, given what we know government is going to spend, existing commitments, plus scaled up transfers, plus the wage subsidy, plus all the other measures, and what we think the government will collect this year leaves a sizable gap. I think it's probably challenging right now to suddenly raise or reintroduce GST or raise SST to collect more revenue when we know purchasing power is extremely weak. Large share of the Malaysian population is earning a lot less, and it will be very difficult to fill that gap. So I think non-tax revenue is a good short-term solution. I think it's probably almost certain what MOF will be looking at first. Essentially, non-tax revenue really means enhanced dividends from GLCs, and particularly from the biggest ones. But of course, that's a one-off, and the more you deplete some of those GLC balance sheets, then the harder it is for those firms to sustain themselves and invest going forward, particularly investing during a recovery. The other challenge, of course, is even before the crisis, Malaysia had a very low level of revenue as a share of GDP. just around sort of 12 to 14% of GDP. The only major economy that collects less in this region is Indonesia. If you look at other, Thailand, Philippines, they all collect a much higher share of GDP. Of course, the UK collects something like 35% of GDP, and then Scandinavian countries, more like 50%. So medium term, Malaysia needs to collect more, not necessarily Swedish levels of taxation, but it does need to collect a lot more revenue. We think, indirect taxation is definitely one area. Malaysia undercollects relatively. I think what less important if it's called GST and SST, perhaps more important, the coverage and the rate. I think politically, it's probably very hard to get away from a 6% rate now. That seems to be sort of set in stone, if you like. But there's an awful lot of exemptions currently. For example, lots of things like, from salmon, avocados, quinoa, all zero rated. We went through the list a few months back. There's a lot of potential to uprate a number of zero rated items, which would increase the collection of SST. Other revenue sources, I think on corporate income taxes, Malaysia's sort of collection levels are already relatively high, and competitively it'd be hard to do more on that. But perhaps some of the incentives could be used a little bit more judiciously and targeted around job creation and technology adoption. At the moment, our sense is they're perhaps not used that efficiently. And then personal income tax is an area where Malaysia undercollects. So perhaps over time, maybe not right now during the crisis, but during a recovery phase, starting to look towards a more progressive personal income tax framework. And then finally, other sources of revenue. Again, Malaysia sort of undercollects in certain areas like stamp duty, property taxes. Of course, there's still no, the real property capital gains tax collects a very small share of relative wealth in Malaysia over time. That's something that the authorities could look at as well.
Okay, thank you, Richard. There's a question here about foreign FDIs. How do we compare to our main other competitors as a stable nation for much reduced Western FDIs? I mean, a lot of our FDIs are from the eastern side, but we will see that the numbers from the European side is much more lesser than Japan or Korea. So how do we compare now in terms of other main competitors? I guess for the participant is asking from a regional standpoint, I would assume.
Okay. So, I mean, in broad terms, Malaysia does pretty well on FDI. Has a lot of advantages, has obviously a geographic location, high quality infrastructure, relatively low cost of doing business as measured by things like the Doing Business Survey and sort of regulatory compliance surveys, strong rule of law, strong intellectual property rights, as well-educated workforce, and relatively lower costs relative to some of the higher cost destinations in the region. I think the challenge, of course, is the level of ambition. I think during the sort of 1970s and 80s, Malaysia was kind of at the top of the leaderboard when it came to FDI competitiveness, and it's probably dropped down that leaderboard in the last decade. And sort of the challenge, of course, is being squeezed between lower cost countries such as Vietnam and other Cambodia and others around that. Yet the sort of leading economies, high skill, high competitiveness like Singapore, still feeling a little bit out of reach. So, I think Malaysia is doing sort of relatively well now, but perhaps not as well as I think it could and should aspire to. Partly, I mean, our sense is that the incentive regime has become very sort of dissipated and very complex. Malaysia spends an awful lot of money on incentives. We think about 9% of revenue every year is given up in incentives, but an incredibly complex scheme. I think there's 60 different separate incentives offered. It's very hard to navigate. And often those incentives have very little impact on investment decisions because it's a very complex process. You have to go to the National Committee on Investments. It takes a long time to deal with MIDA and the other agencies. And so firms either decide or not decide to invest, and those who do decide then apply for incentives afterwards. Also, you have a very sort of complex promotion regime. Again, by our count, there are 32 separate agencies promoting investment in Malaysia. You have MIDA, all the state level agencies, all the sectoral agencies, all the corridors. In the worst cases, they compete with each other and often cause confusion among investors. And again, at a time when public sector resources are very scarce, we think they could be perhaps deployed more efficiently by focusing on a few high-performing investment promotion agencies rather than having this sort of complex web of 32. So I think, in aggregate, Malaysia does pretty well, but we think, frankly, should do better and could use its existing tools more efficiently and then sort of in the medium term focus on some of the key binding constraints that we know exist around particularly skills and technology.
Okay, Richard, since we are talking about FDIs, I'm just wondering your feedback on, from the investor, if you have received any feedback from the investor community on how is Malaysia managing the current situation in dealing with foreign investors at this point. There are so many agencies to support them, but now the response for application and on everything has gone centralized. So how do you think we are managing? Because this will make an impact for future investors. So comparative to, I'm not sure you are able to compare with the other country, neighboring countries and how they are managing with the investor community. But how is Malaysia managing it in the current situation, the crisis situation now, in terms of investor community?
I mean, we don't have a lot of high-frequency data to compare with other countries. It's a little bit early. But some of what we know is that Malaysia's sort of investment promotion agencies are performing now pretty much as they did before the crisis. So the ones that that perform well are continuing to sort of work very closely with their firms. And the sort of difference between, as we have seen it all the way through the line, is that some agencies, are very proactive, very private sector focused. Like InvestKL is perhaps the obvious one, that reach out and work very closely with their sort of client firms and sort of handhold them through the process. And other agencies are much more sort of responsive, who just respond to requests and processes, and those tended to perform relatively less well. I mean, the advice we've given across the network and to the government is, this is a time to focus on investment retention and problem solving among the existing investor base, rather than necessarily trying to target new investments, which are perhaps not going to come under the current scenario. I think the challenge, of course, is that with the heavy centralization of the sort of MCO management regime in MITI, it's putting a lot of pressure on a very sort of small portal and entry point, which is causing a lot of frustration at the moment. I think the hope now, of course, as we go beyond MCO phase 3, that we'll probably move to a graduated process of restarting more and more industries. And hopefully that can take a little bit less pressure off, particularly those involved in export industries.
Okay. Thank you, Richard. We have a number of questions actually, and I've been asking a few. There is quite a number of the stimulus package just that the government has announced. So I'll just group them together. I think one thing everyone wants to know is that, is it sufficient comparative to the other countries? One question is that, your statistics show that you included, you did put Malaysia in the top comparative to some of the countries, the world countries, but your slide actually showed that you included the EPF contribution. People can withdraw. That is the people's money, yeah. And so that's is the stimulus package enough? Number 2 on the stimulus package question asked is, in terms of debts, people cannot pay. I mean, now we have the moratorium to defer payment of debt, and then also there's been given subsidies and grants and all. If they have to pay when things start to recover, will the businesses being able to pay, in the short term? Will that have consequences to the economy? So I think I'll just take that 2 questions from there, and in terms of the stimulus packages. Yeah. One more one is to ask: do they need to give more for business to survive?
Okay, so I mean these are all very good questions, also very difficult ones, given there's so much that we don't know. So the stimulus package, as I mentioned, in terms of the overall total size of measures that have been taken, it's large. 70% of GDP is puts Malaysia, I don't think there are any emerging market or developing economies that have a larger set of stimulus measures than Malaysia. But that's if you include the entire envelope. And of course, you're absolutely right. Reducing contributions to EPF or even allowing withdrawals is very much a short-term temporary solution, and that potentially stores up problems down the line. We know a large share of Malaysians simply don't have enough EPF. Well, not enough Malaysians are contributing to the EPF, particularly those who have more informal employment or gig economy, or those who enter and leave the workforce at different times of their careers. And even those who do contribute, often find themselves retiring with insufficient balances. So, we're making a medium-term problem worse by trying to solve a short-term problem. But, I guess extreme circumstances call for extreme measures, and Malaysia's not alone there. And of course, a big share of the stimulus package includes, the loan moratorium and, efforts to quantify the value of all the different financial measures that BNM has taken to increase regulatory forbearance and reduce liquidity pressures in the private sector. So as I mentioned, the actual fiscal injection is more modest. It's certainly not insignificant, but it's, that it's fairly small compared to what you see in many other economies around the world. As to whether it's enough, well, it really depends on how long this thing goes on for. Essentially, if you kind of read between the lines on the various speeches that the Prime Minister delivered on the stimulus packages, you can see that essentially the assumption is that people will be back to work by May or June, because that's when most of the cash transfers stop. Now, if that's true, if we see sort of broad-based sort of resumption in economic activity by perhaps May or definitely June, restart of sort of most industrial production, economic activity, agricultural production, then I think that the stimulus package has kind of managed to preserve basic consumption patterns, particularly among the vulnerable, and prevent large-scale sort of bankruptcies and loss of employment in firms, particularly in SMEs, then it will have been enough. I think the two risks are, one, that the crisis, and particularly the MCO period, goes on longer, in which case, if it goes on longer than expected, then I think government will need to think about more and a longer period of transfers and wage subsidies. Or perhaps the other risk is, of course, we see a slow pace of recovery. And that's perhaps not hard to imagine, is it? I mean, you can imagine that the MCO will be lifted gradually. The sort of economy gets back to work, if you like, but consumption takes a long time to recover. People are still staying at home. Many people have run down their savings, so it takes a while before they start scaling back expenditures. Exports are weak because the global economy is in recession and commodity prices are low. And in that kind of scenario, then what we need is perhaps maybe not another stimulus package, but a different type of stimulus measures. And it's less about preserving and protecting households and firms, and more about creating enough demand so that the economy can get back to work quickly. And I think that's probably what we'll see in the next few months, is a more traditional stimulus package, which is focused on development spending. And then, and essentially that's what Malaysia did to get out of the Asian financial crisis, spending heavily on construction, infrastructure, and programs that kind of restart the economy and replace absence of foreign demand. And then I think the important thing will be to ensure that, particularly SMEs can participate in that. So it might need, for example, some changes to public procurement rules, trying to package things in a way that allows a broader share of the economy to participate and benefit from sort of prime pumping measures.
Okay, thank you, Richard. Yeah, unfortunately, we have ran out of time. We actually over 10 minutes over time. So before I close quickly, any last words to the audience, Richard? Yeah.
No, well, thanks everyone for listening. Please reach out if you have any more questions. I'm happy to discuss and take any follow-ups. And on those links that we shared, there's a lot more resources and materials if you're interested as well. Thanks very much.
Thank you, Richard. On behalf of BMCC, thank you so much for this discussion and your sharings. There are still questions coming in. Unfortunately, we are unable to. Perhaps, Richard, after this, we can have a quick look at some of the questions. And thank you, everyone, for watching. Thank you. I hope you had an insightful session. Stay safe, stay well. Goodbye for now. Bye-bye.
Thank you. Bye-bye.